Welcome to another episode on my channel. Today, we are diving deep into the realm of personal finance to demystify a common question: secured loans versus unsecured loans. When you try to get a personal loan, the lender might provide the option to borrow the funds solely based on your commitment to repay, or they might demand the utilization of an asset to guarantee the loan. For example, when you get a loan to purchase a car, the car acts as collateral, enabling the lender to repossess and sell the car in case of payment default. Here are some other major differences between secured and unsecured loans. First, let's take a look at secured loans. These types of loans are secured by collateral, like a car or other types of assets. They also have lower interest rates, and they are typically available in higher amounts. Now, let's take a brief look at unsecured loans. These types of loans are not secured by collateral. They typically have high interest rates and are available in lower amounts only. But what is collateral? Secured loans are loans that are backed by an asset, such as a house for a mortgage or a car for an auto loan, which serves as collateral for the loan. When you agree to a secured loan, you give the lender the right to repossess the collateral in case of non-payment. Although repossession only happens when secured loans default, you might still have outstanding debt. When the lender repossesses and sells the asset, the proceeds go towards paying off the loan. If the sale doesn't cover the entire loan amount, you remain responsible for the remaining balance. On the other hand, unsecured loans don't have any ties to any of your assets, meaning the lender cannot automatically seize your property to settle the loan. Personal loans and student loans are examples of unsecured loans since they lack collateral the lender can take in case of payment default. However, if you fail to repay, lenders can resort to other measures like legal action, potentially leading to taking away your wage or wage garnishment. Another important thing that you need to know is the interest rate. Secured loans generally come with interest rates that are lower compared to unsecured loans. This difference in interest rate is because of the fact that secured loans present a lower level of risk for lenders. Secured loans are less of a risk to lenders since the collateral can be seized and sold if the borrower defaults. In contrast, unsecured loans, which lack collateral, are considered high risk by lenders, resulting in the application of higher interest rates. Unsecured personal loans do have higher interest rate precisely because they pose a higher risk to lenders. Without any collateral to secure the loan, lenders have less recourse if the borrower defaults on payments. As a result, they charge high interest rates to compensate for increased risk and potential losses. It's essential for borrowers to be aware of these high interest rates and carefully assess their ability to repay unsecured loans before borrowing. Loan amounts. Secured loans can provide borrowers with the opportunity to secure higher loan amounts. For example, let's consider mortgages, which are available for very large amounts, like $1 million or more. However, it's crucial to be careful and apply for a loan that you can afford. There are times that you might be eligible for a large loan, but it's very important to select a loan amount that you can pay back easily. Making a thoughtful choice ensures you that you can easily manage the loan's repayments without putting yourself in financial hardship. The loan amount that you can borrow as an unsecured loan is usually lower than a secured loan, but there can be always exceptions. As an example, an unsecured loan for home renovations might be up to $50,000, or student loans for higher degrees like medical schools can be much higher. But which option is right for you? When you think about the potential for asset repossession if the loan repayments are not met, you might question the logic behind going for a secured loan. However, people sometimes choose secured loans because their credit history don't let them to qualify for an unsecured loan. Specific loan arrangements are intentionally structured as secured arrangements, like mortgages or car loans, which will let the lenders to seize the property in case of payment default as a condition for application approval. When you secure a loan with collateral, it can impact your ability to replace or switch the collateral, and it often requires additional insurance to protect the lender's interests. For example, with an auto loan secured by your car, if your car gets damaged in an accident, you would typically need to use any insurance proceeds to repair the car, even if it still functions properly. The lender wants to ensure their collateral, the car, remains in good condition and is protected from any potential losses. On the other hand, if the same loan was unsecured, you would have more flexibility in using insurance proceeds as you can see fit, since there would be no specific collateral tied to the loan. Securing the loan with collateral helps provide a sense of security to the lender, but it also comes with some limitations and requirements that borrowers need to be aware of before making their decision. It's essential to carefully consider these factors and weigh the pros and cons of secured versus unsecured loans to make an informed borrowing choice. So to sum it all up, when it comes to secured and unsecured loans, there are a few things to keep in mind. Secured loans can get you low interest rates and bigger loan amounts, but they're also tied to your assets, which could be taken if you can't make the repayments. Unsecured loans, on the other hand, might have high interest rates, but you don't need to risk your belongings. When you're getting a loan, think about your credit history, how much risk you're comfortable with, and what you're borrowing for. It's like choosing between playing it safe with collateral or being more flexible without it. And don't forget, getting advice from money experts can be super helpful. Just remember, whatever you pick, being responsible with your loans is very important for a solid financial future. Thank you very much for watching this video, and if you've liked it, please like and subscribe for more content.